Cathie Wood has become one of the most popular fund managers in the world, and for good reason. Her flagship ARK Innovation ETF skyrocketed in 2020, posting an amazing return of 148%. Moreover, a $10,000 investment in the ARK Innovation ETF during its 2014 inception was worth more than $75,000 at its peak in February of 2021. More recently, Cathie's investing style has gone out of favor and her returns have been heading in reverse. That's caused her to catch a lot of flack in the media and a lot of ire from her investors. Both Brian and I have a tremendous amount of respect for Cathie Wood, and we like and own many of the same businesses that she does. However, history has an important lesson to teach investors if they hope to make money with the most popular fund manager of the day. What is that lesson? We'll tell you everything you need to know next. My name is Brian Feroldi.
And my name is Brian Stoffel.
This video is sponsored by our friends at YCharts. More on them later. Brian, I think we should start by talking about one of our favorite investors of all time, Peter Lynch.
That's right, Brian. And for people who don't know, Peter Lynch was the manager for Fidelity's Magellan Fund from 1977 through 1990. He was also the author of a number of famous books. Those books include One Up on Wall Street and Beating the Street, among others.
Peter Lynch became one of the most famous mutual fund investors in the world because when he was heading up the Fidelity Magellan Fund, it delivered a 29% annualized return during his time. That turned a $10,000 investment in 1977 into $274,000 by 1990.
But those returns come with a huge asterisk, and that's the whole point of this video. As detailed here in Spencer Jacobs' Heads I Win, Tails I Win, Lynch went back and found that the average investor in his fund only made 7% per year during the same period.
To showcase how important of a difference that is, instead of 10,000 turning into 274,000, with a 7% return, 10,000 only returned into 24,000. That's more than a 10x difference.
So how could that happen? Well, it's actually pretty easy to understand once you think about investor psychology. When Lynch had a really good quarter, his funds went up and people poured their money into those funds at points like this.
However, all funds and all stocks, even the greatest ones of all time, experience periods of volatility. And whenever his fund experienced a flat or down period, investors pulled their money out of their fund. In essence, they were buying high and selling low. Hence why there was such an enormous difference in what the investment did and what the investors earned.
But Brian, Lynch wasn't alone. There are other examples, perhaps even more extreme, of this same phenomenon.
During the 2000s, which was a lost decade for investors, the number one performing mutual fund was run by Ken Hebner. Ken Hebner was the manager at CGM Funds, and his CGM Focus Fund delivered an 18% annualized return during a period when the S&P 500 was down.
As you can see, that means that his fund vastly outperformed the market during what is commonly referred to as the lost decade.
However, while CGM Focus Fund had a phenomenal decade, the average CGM Focus investor did not.
How bad did it get? When Morningstar went back and tried to calculate the average investor returns in Hebner's fund, they found that they lost 11% per year.
Now think about that for a second. The fund delivered a positive 18% annualized return, but the average investor earned a negative 11% return. How could that be? Well, you can probably guess the answer. Investors, such as myself, poured money into the CGM Focus Fund in 2008 after the fund went on a tremendous run. However, after pouring all that money into the fund had a huge downturn, during which time a lot of investors, including me, pulled their money out of the fund. So even though the CGM Focus Fund had a phenomenal 10-year return, that's how investors such as myself ended up with a negative return from this fund.
Now, Brian, if we look at the numbers, we can really highlight what a difference that makes. If you invested $10,000 and it grew at 18% per year for a decade, you'd be left with over $50,000. However, if you got the average investor returns of negative 11% per year, you would have started with $10,000 and finished with just over $3,000.
Now, when this fact was shown to Ken Hebner, he had a great quote. He said, "I don't know what to say about that. We don't have control over what investors do." Guess what? He's right. As a fund manager, he has no control over when investors give him money, and he also has no control over when investors pull their money away.
Now, Brian, It might be easy to think that this is a phenomenon that only occurs with highly successful funds, but the fact of the matter is it happens all the time. Dalbar has been running the numbers for a long time, and in this period, which starts in 2001 and ends at the end of 2020, an S&P 500 returned about 7.5% per year, but the average investor in an S&P 500 fund returned less than 6% per year.
That 1% difference might sound small, but it's the difference between $10,000 turning into almost $42,000 and $10,000 becoming just $32,000.
So we've already touched on this a bit. Why does this happen? Well, it's because investing is carried out by humans, and humans are emotional beings, and we go through a cycle of emotions right along with the market, from the euphoria of market highs down to the despondency and depression of market lows.
These are perfectly natural emotions for investors to experience. When stocks or a fund are going up, we want in on the action and we are enticed to buy.
And then when they fall, as they inevitably will, we feel fearful. And when we feel that fear, we go and we sell the stocks that we own.
If you've studied investing at all, there's no doubt that you've come across Warren Buffett's famous quote, which is investors should attempt to be greedy when others are fearful and fearful when others are greedy. That's a very common thing to say.
However, the difference between theory and practice is enormous. And Brian has a great example of this.
When you're saying to yourself, I'll be greedy when others are fearful, that's kind of like looking at a picture of a snake and saying, I won't be scared if I see a snake in the real world. But imagine how you would actually react if that same snake was all of a sudden real and thrown into your lap. You would probably freak out if that happened. That's the difference between being able to deal with volatility and a drawdown in theory and experiencing it for real.
And it's important to remember that if we think about this in a vacuum, we forget all the context that surrounds it. 3 years ago, I got to interview Nassim Nicholas Taleb, and he talked about how investors don't get the same return as the market. He said, if you ever have an uncle point where you're forced to liquidate, then your returns will not be the stock markets. It will be the returns to your uncle point, which is almost always negative.
In other words, even though what you're investing in can have a positive return, that won't matter if you sell after the fund or investment goes down. Your returns will be your starting point to when you reach your uncle point, not what the investment itself does. Now, this might sound like a downer, but the good news is we think there's things that investors can do to protect themselves from making the wrong decisions. We'll cover those 5 things next. Before we do so, we wanted to give a shout out to this video sponsor, which is YCharts. So if you've been following our channel for any period of time, you know that we're constantly using YCharts to make complex analysis more visual, intuitive, and shareable. Brian and I have used YCharts for years to do fundamental stock research, but the platform is actually far more powerful than that. It can be used to compare stocks, mutual funds, and ETFs on nearly any metric that you can think of. Paid users can also easily add their own logo to make it easy to distribute via email, blog, newsletter, or on social media. If you're interested in giving YCharts a try for free, visit ycharts.com using the link in our episode description or follow them on Twitter at YCharts. All right, Brian, we think that there's 5 things that investors can do to protect them from selling at the wrong time.
That's right. And the first one is simply being aware of this tendency to buy high and sell low. If we look at some of the best investments of the past 30 years, we see a number of companies that have created millionaires. However, they've taken their investors on quite a ride.
Every single one of the best performing stocks of the last 10, 20, and 30 years have put their investors through immense down periods. If you sold these stocks after they experienced a huge decline, your returns would not be positive and you would not reap the life-changing wealth that these stocks have provided.
Carl Richards runs a website and has a book called The Behavior Gap, and he sums up the whole issue succinctly. He says investor behavior matters. It probably matters more than skill. The clearest evidence of this is that investment returns and investor returns are almost always different. You earn the investment return if you invest your money and then don't touch it. No buying, no selling, just holding. But real people rarely invest this way. Real people chase performance and invest by looking in the rearview mirror.
I know that I was caught up in this phenomenon in 2008. That's why I was the rube buying Ken Hebner's fund at the top and selling after a big decline. We firmly believe that if you study market history and are just aware of this fact, you will have a much lower chance of selling at the wrong time in the future.
So let's move on to the second thing you can do, and this is also very important. That's make sure that you keep any money that you will need for any reason over at least the next 3 years out of the market. Even if prices look highly attractive, nobody knows what's going to happen in the future. And if you need that money to pay for a house, a birth, college tuition, or retirement, do not leave it in the stock market.
Over a 1, 2, or even 3 year period, anything can happen in the market. If you know you're going to need money for a real life expense, keep that money just in cash.
Third, it's important to have more conservative personal finances, something which you have complete control over.
I'm a huge fan of keeping your personal finances extremely conservative. That means paying off your debt, have multiple sources of income, having a 6 month emergency fund, and using plenty of insurance to protect yourself. If you know that your personal finances are rock solid, that makes it so much easier to deal with the inevitable volatility that comes with investing in the stock market.
Brian, our fourth step might be one of my favorite ones, and that's to start keeping an investment journal. I know for myself, when I started keeping an investment journal, I was able to go back and see what I was thinking 1, 2, 3, 4 years ago. And most importantly, I was able to see how I was sure something would happen in the near term future. But because I was looking back, I could see that that thing that I was so sure of, it never came to pass. It made it very clear that it is impossible to predict what's going to happen over the short term.
Fifth, surround yourself with a positive investment community. Go on Twitter, go on YouTube, go on the Motley Fool's discussion boards, listen to positive podcasts about investing. Dealing with an inevitable downturn is so much easier when you have people that you can talk to calm you down when you are feeling emotional about investing.
Now, we started this video by talking about Cathie Wood's ARK Innovation Fund, which is out of favor right now. But we also want to point out that she's actually doing a very good job of managing her investors' expectation.
Yes, Cathie has a podcast, YouTube channel, email newsletter, and she's also making regular appearances on CNBC. We think that's going a long way to help calm her investor base down, which could help them to stick with the fund for the long term. Those are advantages that Peter Lynch and Ken Hebner and fund manager of the past just didn't have.
And when we look at the numbers, this proves out while there might be more people pulling their money out of ARK than putting it in, by and large, there hasn't been a huge exodus as the stocks have fallen. That speaks volumes to the job that she is doing at managing investor expectations. But remember, whenever you invest in a fund like this, you have complete control over what you do with your money.
Both Brian and I have experienced tremendous volatility in our portfolios over the last year. However, we also have huge conviction in our investing processes and are committed to holding our stocks for the long term. That, combined with our conservative personal finances, make us believe that we're set up for long-term success. We hope that you found this video to be helpful. Let us know in the comments section below how you deal with volatility. Brian's out.